Hello! Most companies buy insurance the same way they buy coffee, habitually and not economically. But risk isn't a bill to be paid, it's a capital allocation decision. So here's the real question: how do the best run corporates decide what to insure, what to retain, and when to use their own balance sheet instead of somebody else's? This video is about the hidden economics of risk, the techniques used by the top 1% of risk and insurance managers to measure, manage and monetize uncertainty. And once you see how they do it, you'll never look at insurance again the same way. Every decision in risk management lives inside this triangle. At one corner, what the company spends to manage risk: premiums, deductibles, retained losses. At another, what its cost of capital is, the price of volatility on the balance sheet, and how much risk the business is willing to carry in pursuit of return. The best firms don't think of insurance as protection, they think of it as pricing the volatility they can't afford to keep. The starting point is the total cost of risk, or TCOR. That's not just your premium, it's every dollar linked to uncertainty. Premiums, retained losses, captive funding, risk management program costs, and the cost of capital tied up in volatility. The smartest companies now express TCOR as a percentage of revenues, or EBIT, so risk has to compete with other uses of capital. According to Aon's 2024 Global Risk Management Survey, the average TCOR across the S&P 500 sits around 1.4% of revenues, but the range can vary fivefold depending on sector. So risk isn't just an operational metric anymore, it's a performance one. Insurance is just a substitute for capital, and the real question isn't what premium can we afford? It's whose capital is cheaper, ours or the insurer's. Companies estimate expected retained losses, the average cost of risk they'll pay each year, tail volatility, or the rare but extreme events at the edge of the loss curve that can wipe out earnings in a single quarter, and a capital charge for that volatility, how much equity must be held against it. The marginal cost of capital decides how much risk to keep. McKinsey's 2023 Global Insurance Insights found that corporates optimizing their retentions can improve post-tax returns by 50 to 80 basis points per year, simply by reallocating risk capital more effectively. And that's why this isn't about coverage, it's about corporate finance. Once you've quantified the volatility, you can model the trade-off. Let's make it real. A retailer retains property losses under $5 million but buys $200 million in limit because its supplier network makes the tail asymmetric. A manufacturer funds cyber risk through its captive up to $10 million, then buys reinsurance for volatility beyond that. That's not just risk management, that's portfolio optimization for uncertainty. Captives used to be viewed as tax or accounting vehicles. Now they're capital allocation tools. Modern captives retain layers efficiently priced below external markets, use protected cell companies and reinsurance sidecars for scaling, benchmark volatility against corporate hurdle rates. Marsh's 2024 captive benchmarking report found over 7,000 active captives worldwide, managing $110 billion in premium, with 65% citing capital efficiency as their primary motivation. Or as I like to put it, a captive is a balance sheet expression of confidence. It's the CFO saying, "We know this risk better than the market does." The next wave is analytics. AI and simulation modelling are quantifying risk appetite in economic terms. Corporates are now integrating risk, treasury and finance into one view, linking predictive loss analytics directly to balance sheet volatility. Deloitte's 2024 study found that 45% of large corporates now tie their enterprise risk models directly to capital planning, up from just 19% 5 years ago. That's not risk transfer, That's risk financing intelligence. But power demands precision. If risk data becomes capital, it needs governance like capital. That's why 80% of insurers and large corporates now have or plan to build explainable AI frameworks for pricing, reserving, retention. Because if you can't explain your model, you can't defend your decision. In the end, insurance is just one way to fund uncertainty. The question isn't how much coverage do we have, it's how much volatility can our balance sheet afford, and what's the most efficient way to pay for it. That's not just insurance, that's capital strategy. So the next time someone says, we just renewed our insurance, ask them, or did you just refinance your volatility? If you enjoyed this, subscribe to Risky Business or email me for the one-pager that accompanies this video. See you in the next one.